Major currencies weakened against the dollar and yen in quiet holiday trading. Weak economic data from Japan and China were part of the factors that's driving risk aversion. Meanwhile, uncertainties in the Eurozone also weighed down sentiments. The dollar index broke the 80 psychological level, but there is no sustainable buying so far. Looking ahead, PMI data will be the main focus today, with Swiss SVME PMI, Eurozone PMI manufacturing, UK PMI manufacturing and US ISM manufacturing featured. In Japan, the Tankan survey showed that the country's manufacturers have turned more pessimistic, as weakness in exports delay recovery. According to the Bank of Japan, the sentiment index for large manufacturers slipped to -3 in the third quarter of 2012 from -1 in the prior quarter. Confidence of small manufacturers dropped for a fourth consecutive quarter to -14 in the third quarter, compared with the second quarter's reading of -12. On all industries basis, sentiment weakened in all scales of industries as strong Japanese yen dampened exports, while anti-Japanese sentiment in China due to the Ryukyu Islands dispute pressured Chinese demand on Japanese goods, with the biggest sufferer, the automobile sector. The official Chinese manufacturing PMI climbed higher to 49.8 in September from 49.2 a month ago. Despite the mild improvement, a reading below 50 signaled that the manufacturing sector remained in contractionary basis. Over the weekend, the data compiled by HSBC and Market was revised higher to 47.9 from the flash reading of 47.6. Indeed, the September reading should be a seasonally strong one. The disappointment coming from the two sets of data heightened concerns about the outlook of China's economic growth. Earlier last week, the PBOC reaffirmed that it would fine-tune the monetary policy to ensure achievement of the annual growth target. However, a liquidity injection to the market through reverse repos over the past weeks was obviously insufficient to bolster the slowing economy. The market is hoping for more substantial measures such as a RRR reduction and rate cut. Results of an independent bank's stress test in Spain showed that there is a capital deficit of €59.3 billion. That's the amount of extra capital needed to ride out a serious economic downturn. And such an amount was slightly lower than June's estimate of up to €62 billion. Taking mergers and tax effects into considerations, the needed capital would be further reduced to €53.7 billion. Under the worst-case scenario, Spain's GDP would contract -4.1% in 2012, -2.1% in 2013 and -0.3% in 2014. Unemployment would also jump to 27.2% in 2 years' time. The Spanish Prime Minister hailed that the stress tests were the biggest transparency exercise ever done, and he emphasized that Spain will pay back the needed money. The European Central Bank also hailed the stress tests as stringent and the asset quality review as thorough. Moodys said that recapitalization will materially enhance the solvency of affected institutions and help restore market confidence in Spain's banking system as a whole. And the rating agency noted that the upcoming recapitalization is intrinsically credit positive for all Spanish banks, because it includes more banks and more capital than prior efforts. However, Moodys noted that the recapitalization amounts published by Spain are below what we estimate are needed for Spanish banks to maintain stability in our adverse and highly adverse scenarios. And negative sentiment could undercut the government's efforts to fully restore confidence in the solvency of Spanish banks. Also, Moodys is set to publish a review on Spain's rating after September, but no firm date is set. The Troika team also returned to Athens yesterday. Greek Prime Minister Samaras will need to finalize the €13.5 billion austerity package to secure the €31.5 billion tranche of bailout funds. Also, Samaras will need to use his last efforts to seek a 2-year extension to the fiscal adjustment program. Eurozone finance ministers will meet next week on October 8 and after that, the EU summit on October 18 and 19 are expected to decide on the issues. Latest FTF data showed that euro shorts dropped to 50,200 contracts on September 25, compared to 73,500 contracts a week ago. That's also half of the 102,000 contracts in early September. Sterling longs gathered momentum and rose to 27,100, a 2012 high. Yen longs are relatively unchanged at 21,100. Due to an improvement in risk appetite, Australia longs rose again to 89,600 contracts, making a 2012 high. Canadian dollar longs dipped a bit to 105,300 contracts, compared to the 111,900 contracts a week ago.